Welcome back, one and all. Great that you could join us. Ed's the best. Okay, we're going to get started. July also represents earnings season, and there's a natural market cycle that exists on a short and long-term basis that kind of took me a long time to figure out. But once I did, it really helped me put the price action into consideration. And when we talk about the market, certainly it's easy to talk about the stock market because we have the earnings, but it's equally as relevant, and there's a direct correlation with the foreign exchange market. And I think if we're going to trade foreign exchange market, we should certainly be aware of all the other markets that have an influence to it. It's a lot more, in a sense, it's a lot more complicated, because if we're going to trade a commodity like orange juice, we simply trade orange juice, and we would look to the forces that represent supply and demand, that affect supply and demand in orange juice. Same thing with gold. But when we trade foreign exchange, every other market goes into the foreign exchange market. Or the foreign exchange market, in other words, is made up, it's comprised of every other market. So it's important that we're aware of stocks and bonds and commodities and everything else. So, with that said, we're looking at the Dow Jones Industrial Average charts. And there's a natural market cycle. Take a look at, by the way, the bars at the volume. That's the volume. The volume tends to peak right around earnings season. This volume happened to actually peak in the first week of August, second week of August. That was unusual. Usually, we would expect this to occur sometime in July. I'll tell you why in a moment, though. But when we look at the chart, we look at the periods of time that the volume peaked. We take a look at March of this past year. That was probably the beginning of earnings season, first quarter earnings season, March. Actually, we say April, but sometimes the earnings seasons, they tend to occur a little bit earlier, a little bit later, depending on what other factors are involved at the time. In terms of the cycle, during earnings season, expect high amounts of volatility. Expect breakouts. Expect markets to get really, really trendy, meaning new highs, new lows. Outside of earnings season, then we expect the markets to quiet down, to form range-bound patterns. There we can use a buy low, sell high approach. Now, the foreign exchange, it's not that clear cut, because right now we actually have some really interesting trends developing in a period of time that we normally expect stocks to stay put. And today's candlestick, by the way, and the reason why I wanted to bring it up is you take a look at this range-bound pattern. This is normal for August and September. This is what you want to see. Take a look at the Bollinger Bands, which are the top blue line and the bottom blue line. They're relatively close together. Right now, the lower Bollinger Band on the down chart is 10,600. The upper band is 11,500. That's a 900-point spread between lower band and upper band. Can't even really see it. But if we go back, we have the upper band above 12.8, 12.9. The lower band is at 10.5. I mean, you're looking at a 2,400 pip difference or point difference between the lower band and upper band. That is earnings season, a breakout when markets tend to make new lows and new highs. Today's candlestick would be, if we close here, would be the first candlestick to close below this uptrending support line that we drew going back to August 9th. The next lowest low and the last lowest low, by the way, on the Dow Jones Industrial Average is 10,444 on a futures basis. That's only about 60 or 70 more points. If we break another 60, 70 more points, Dow futures right now are 10,507. If we get below 10,444 on the Dow futures, that will now put us at lows we have not seen go all the way back September of last year, September 2010, 1-year lows. And I believe, if I'm not mistaken, the S&P 500 already accomplished that yesterday. That is huge. 1-year lows, here's the S&P 500. 1-year lows, 1-year highs on the chart are big. We are at 1081 on the S&Ps, hitting lows at 1077. Yeah, by the way, we just hit new lows on the S&P 500. S&P 500, 1080 were the former lows of August the 9th. Go to a weekly chart. The last time the S&P 500 touched the levels below 1080 was September of 2010, last year. The reason why that's so important is because you think of every single trader out there, not even the trader, think of the individual with some sort of a retirement plan, a 401k plan, a pension plan, something in the market that we emotionally connect to our long-term security. When those investments are now at 1-year lows, and most people do not sell short stocks. Most investors only go long stocks. So when the stock market goes down, you can't say it's like, when the euro yen goes down, and yeah, there's euro yen shorts out there that are pretty happy about it. It's not the case in terms of the stock market. When the stock market goes down, I'm guessing 95%, maybe even more than that, of capital in the stock market is long. Mutual funds are long. Hedge funds go short, but they have to be right. Point being is that we were in a range in the Dow Jones Industrial Average for a long time. Today might be the first sign of a change to a trend, which we would expect to happen in October. Now, a little bit about the last earnings season. If you remember last July, take a look at the stock market in July. July, by the way, is supposed to be a very active month. When in the old days, when I used to day trade stocks, July was the best month of the year for me and for everyone we worked with. July this past year was probably horrible for day traders. Lower Bollinger Band on the Dow chart was 12,375. The upper band 12,759. 375, 759. You're talking less than 400 points difference on the Dow Jones Industrial Average daily chart Bollinger Band. The reason why I haven't read this anywhere, but the reason why I think the volume and the volatility was so poor in July is because if you remember in July, we had corporate earnings. Some companies reported better than expected earnings, other companies lesser than expected earnings, but the market didn't move because the market was completely consumed with that debt ceiling crisis, that debt ceiling debate that we had in the U.S., where the Democrats and Republicans, everyone in Washington stood up in front of the TV camera and they said, no, I think we should raise the debt ceiling and do X, Y, Z. And the other guy says, no, I think we should do A, B, C. And it was sort of like almost an embarrassing display of how dysfunctional the political system can be. And, despite when we really need, consensus. Well, S&P, Standard & Poor's, tended to agree with us, if you thought that, because Standard & Poor's downgraded the U.S. credit rating in the beginning of August, and they did not say it was because the debt ceiling was too high. They didn't say because of the deficit or anything like that. There's other countries out there with much higher deficits than debt to GDP ratios in the U.S., like Greece or Spain or Portugal. But the reason why the U.S. credit rating was downgraded was because they had S&P, Standard & Poor's, a credit rating agency, had no confidence in the political system that would be actually able to get together and agree on something. That's why they downgraded the credit rating. Now, a downgrade from AAA to AA plus just happened a couple days ago in New Zealand. It's not the end of the world. And we know this, not just because I'm saying so, but I know this because I'm looking at the 10-year bond, and it only pays in the U.S. a 1.74% yield. If there was really a risk that the U.S. was going to default on their credit rating, on their bonds, I should say, then that yield would be super high. You look at Greece's bond yields. Greece, 10-year bond in Greece pays 23.08% yield. That's huge. Portugal, if I'm not mistaken, is that Portugal? Yeah. Portugal 10-year bonds, 11.2% yield. U.S. 1.74. We can look at Canada 3.99. We can look at any of the bond and get a comparable comparison. UK 2.22% yield, etc. So again, there is not a real risk that the U.S. is going to default on the credit, but it was a stab at the fact that they do not believe the political system will be able to come to a consensus and to say, okay, we're going to find the spending cuts here. We have to raise the debt ceiling because otherwise, to avert a government shutdown, we have to raise the debt ceiling. But where are we going to get the spending cuts from? Well, one side says we should raise taxes, and the other side says, no, don't raise taxes, cut spending. And given the fact that we're now coming into the next election cycle, I mean, it's about a year and change away, now the Democrats are super Democrats and the Republicans are super Republicans, and everyone is posturing for, their own position. That's what makes things really kind of complicated. That's why they could downgrade the credit rating. Now, I like to think of the markets as a sort of a capacitor or a rubber band that will store up a certain amount of inert energy and then release that energy once there's a catalyst that lights it. That the market sometimes is very, I don't know what the right word is, I guess conducive. That the market will show or reflect and react to every piece of economic number. I think that's kind of happening right now. Notice when good economic numbers released, by the way, great example is yesterday. Let's see if I can, this is a Dow chart. It was 1400 yesterday, so we're going to have to zoom out here. I think these markets right now in terms of the stock market and foreign exchange goes one and the same. We'll look at some foreign exchange charts in a second here. All right, I have to go to a 15-minute chart. Okay. So I'll draw a little line. Well, I'll even better, because I want you to see the chart. Okay, so US ISM. This is a great example yesterday. All right, you see this little spike here where I drew that US ISM? That's the ISM manufacturing numbers that were released yesterday. Right now we have a market that is able to react to news. US ISM manufacturing numbers, prices paid, construction spending numbers, all were better than expected yesterday. Stock market says great. It went up. Eventually did go down for another reason. I'll talk about that in a sec. But the fact of the matter is the market reacted. In July, the market was not reacting because most traders that caused the market to react, traders were not reacting in all of July. Corporate earnings are good, I don't care. Corporate earnings are bad, I don't care. I'm waiting for that debt ceiling crisis to become resolved. Once it was resolved, and the S&P Standard & Poor's credit rating solved that answer for us and said, you know what? The answer's not good. Downgrade. The market all of a sudden had all of this inert tension that was built up. All those stocks that reported earnings, traders knew what they wanted to do, but they didn't press the buttons. They were waiting for the big catalyst. The big catalyst was, of course, the credit rating downgrade. That's what I think really caused that huge move lower. Let's go back to the daily chart. This huge move is what I'm talking about on the Dow Jones Industrial Average in August or so. And of course, the foreign exchange markets reacted in kind. How did they react? Well, we have the lower yielding currencies like the dollar and the yen, and investors, or I should say capital, tends to go into the dollar and the yen when there's, as a flight to safety, when they're running for the hills. Now, when they're buying the yen and buying the dollar out of fear, they're selling other currencies. That side of the equation is a little bit more complicated. Sometimes they'll sell the Aussie and the Kiwi. If traders simply want to get out of risk aversion, higher yields, because of Aussie and Kiwi, Australia last night kept their interest rates at 4.75%. It's a lot more than the 0.1% in Japan, or 0 to 0.25% in the U.S. Sometimes capital is moving out of commodities. Then they'll sell the Aussie, Kiwi, and CAD. Sometimes capital moves out of other currencies that have specific issues, like the Eurozone. Why is the Euro so weak? It's not because it has higher yield, and it's not because it's a commodity-based currency. Neither applies. The Euro is so weak, obviously, because of Greece and the debt contagion crisis and the possibility of a Greek default. And the speculation of Greece default, will Germany and France and the stronger economies have to pay for it? or what will be the implications to the EU and the overall euro currency. That's why the euro is going down. By the way, I just put together an article last night that is on FX Street that talks about exactly that. If you're interested. Question: so Dow is going to develop a new downtrend after Bollinger Band is closed below that. Isn't it due to no QE3 printed money that popped out? Great question. I think so. I think my opinion is that I think the Dow continues lower. I think October will be the catalyst. The earnings season in October will be the catalyst to send stocks lower. Now, when I say lower, that's my opinion. I mean, well, everything I say, of course, is my opinion. But you listen to a lot of analysts out there, they do build some good cases for why stocks could go up. I could talk about the VIX, the volatility index, which is at 45. Typically, when the VIX gets to 40, the market finds a bottom. And we can talk about stocks like AT&T and Verizon that offer 6 and 5% yield respectively. When you look at the bond market, it pays almost no yield. That 5 and 6% in the blue chip stock all of a sudden does not look that bad, and that might be the source of a lot of capital. So yeah, I think the stock market's going to go down, but the market's not convinced yet. At the moment, the trend appears to be the downside, but we still haven't broken below that range. And yeah, the lower Bollinger Band is the important level, but 10,444 are 1-year lows on my futures charts at least. How do you define a safe haven currency monetary policy? This is my answer. I don't know if it's right or not. I define safe haven currency as, I'm looking for the VIX to answer your next question, by the way. To answer the next question. Safe haven currency is a currency that cannot cut interest rates anymore. U.S. interest rates are at 0 to 0.25%. They can't cut rates anymore. Now, quantitative easing 1, quantitative easing 2 sort of redefined the fact that they actually can cut interest rates. And I think that's what led to such a weak dollar for so long. Quantitative easing 3, which nobody's calling it quantitative easing 3, I'm convinced it is. I'm talking about Operation Twist. That's actually strong for the dollar. But to get back to your question, I define safe haven currency is in a currency that cannot cut rates anymore. Now, the euro's at 1%. They could certainly still cut rates. The pound is at 0.5%. They could cut rates. I would not define the pound as a safe haven currency, though. Really, the safe haven currency is the yen and the Swissy. Because the yen and Swissy, Japan and Switzerland are export-driven economies. Japan exports automobiles and consumer electronics and lots of other great stuff. Switzerland exports banking services, financial services. Export-driven economies want low interest rates. So even at the height of the greatest point of the stock market in 2007, when interest rates in the U.S. were 5.25%, Japan was at 0.5%. That's a safe haven currency. That's a currency we run into when we know that they don't mind having a weak currency. They don't mind having, they actually prefer to have a weak currency because a weak yen makes it makes their exports more attractive. The fact of the matter is, a safe haven currency, think about it this way, a safe haven currency is a currency that Japan does not want you to buy when you need safe haven. Because a strong yen, when the euro yen, dollar yen, Aussie yen goes down, that strong yen hurts Japan. But in short, I consider it a currency that they really can't cut interest rates anymore. Now, here's the VIX chart, by the way. Let me refresh my charts here. This is from Yahoo Finance. I'll send everyone the link as well. Try not to go off course here, but It's actually right on course. Let's go to a max chart here. Actually, no, the 5-year was okay. All right. Now max. Okay. So the VIX, which stands for the Volatility Index, in other words, the Fear Index, basically measures the price of options on the S&P 500, calls and puts. Traders tend to buy puts or sell covered calls. In other words, make options transactions when there's a fear that the market's going down. The VIX tends to go up when fear goes up, when the market's going down a lot. 40 is that magic number, by the way. That when, I don't know what 40 necessarily stands for. I don't know if it's 40% of the stocks have options hedging them, or I really don't know what the 40 stands for. But 40, based on the chart, is that magic number that says, okay, there are so many traders that have hedged themselves against the market going down that now if the market goes down, they're not losing money anymore because we're hedged. The market can go down, we don't lose money anymore. Then all of a sudden it doesn't matter if the market goes down. In fact, it's better if it goes down, because then my hedge will protect me and I can buy stocks cheaper. That's when markets tend to hit big bottoms, at least historically. The VIX hit a very big low of, big high. Very big high. I'm looking for the date here. Where's my date? August. That big sell-off we talked about in August, that's when the VIX hit just a little bit above 45. The VIX right now, by the way, is at 45.45 based on last night's close. Of course, there was that very, very big high, 2009. October 2008. By the way, that was October too. October tends not to be such a good month. The VIX was over 80 at that point. That was a once in my chart goes back to 1990. That was a once in a 20-year occurrence, and probably actually even more than that. If you take away October of 2008, the VIX touched levels near 40 in 2002, 2001, 1998. Before that, we go back to 1990, and it barely didn't even get close to the 40 level. So, point being is that the VIX at 40 is actually kind of unusual. It's really unusual. I mean, if you think about it, the VIX did not touch 40. My charts go back to 1990. From 1990 to 1998, 8 years, the VIX didn't touch 40. This is twice in 2 months the VIX is touching 40. And 3 times in 3 years. Wow. So, that's the VIX. The low end is 15, 10 to 15. When the VIX is 10 to 15, it means that so few traders are using options to hedge their positions. They're so complacent, they're so comfortable at the market that maybe it's a good time to get a little scared. That's the VIX. In terms of earnings season, okay, so wait, I don't want to lose track of what I was saying. Okay, so now, we think about earnings season in terms of the foreign exchange market. And we say, okay, if I am of the opinion that I think earnings season in October is going to be a disappointment, I personally think that's going to be the case. I think there's going to be more bad news than good news. I think stocks are more likely to go down than up. We already have gone down quite a bit, but I think we're going to go down more. If that's the case, capital, and if I'm right, I should say, capital will move into the low-yielding currencies like the yen, the dollar, or the Swissy. Now, the yen, Bank of Japan has intervened. Even more shocking of an intervention was the Swiss National Bank. When we saw that huge move, remember that huge intervention? The Swiss National Bank they said that we don't want the Euro Swissy to ever go below 120. That's the Euro Swissy. So far, it has not gone below 120. It hasn't gone that much higher, as charters, but it hasn't gone down either. That's the Euro Swissy. So I don't necessarily I think traders are kind of scared of buying the Swiss franc. I am. So I would buy another currency. Well, the yen, but then again, the Bank of Japan's intervened. And if you notice, you take a look at the dollar-yen chart, the dollar yen has not broken those very big lows going back to August 19th, 75.93, which, by the way, I think represents the low of the Bank of Japan intervention. I have heard some speak from, I think it's from the Bank of Japan. I don't know if it's from an economist or the Bank of Japan itself, and they're not very happy with the euro yen. The euro yen hit lows not seen in 10 years. That's huge. I know the chart's kind of a mess. But take my word for it. We have not touched these lows in the euro yen since 2001. All of those exports going from Japan to Europe are now at 10-year highs in terms of their prices. That's the last thing that Japanese economy, trying to recover from the earthquake and tsunami disaster, needs is 10-year highs in the prices. I have not heard this anywhere at all. It's just my speculation. I would not be surprised, though, if the Bank of Japan maybe has a little bit of intervention against the yen, against the euro, I should say. Now, typically the Bank of Japan intervenes against the dollar. Do remember a euro yen intervention, but that was the result of the tsunami and earthquake last March. And number one, it wasn't the Bank of Japan that intervened. It was the independent central banks, the other central banks, I should say. It started in Europe. The European Central Bank intervened. They bought euro yens. Then, was it the Bank of England or the Federal Reserve? Federal Reserve buys dollar yen. The Bank of England buys pound yen. And it went around the world. The Reserve Bank of Australia bought Aussie yens. They intervened on behalf of the Bank of Japan, kind of to help them out, because the Bank of Japan needed to keep their capital to put back into the economy to, help, obviously, the economy recover from that awful disaster. So that was the only case I remember a euro yen intervention, but that wasn't even the Bank of Japan. That was the ECB, the European Central Bank. Now, that would be interesting. I think it really would be interesting to see a euro yen intervention. I would not be surprised, though. But because of the speculation of intervention, traders are buying the yen, but there's a risk in buying the yen. I think traders are definitely not buying the Swissy. I definitely am not, because I don't want to get caught in another pound Swissy, euro Swissy, dollar Swissy intervention. That's not nice at all. That's a guaranteed stomp out, if you're lucky enough to get stomped out. So I think the dollar, one of the reasons why the dollar has become so strong, one of the reasons why I think the dollar will continue to be that safe haven currency. Again, earnings season, October, if I'm right, if stocks go down, I think that the stocks with troubles like euro, maybe the pound, Reserve Bank of Australia left rates unchanged earlier today, but there's growing speculation they may cut rates. There's a lot of reasons to believe a lot of other currencies go down. So the question is, what currency do I buy? And again, I think it's the dollar. Not only because of the speculation of intervention in Japan and Switzerland, but also because of quantitative easing 3, but nobody's calling it quantitative easing 3. They're calling it Operation Twist. I think they got a new name for it because quantitative easing 2 was so unsuccessful that politically they said, listen, we'll have another plan, but we're not going to call it QE3. Please, let's think of a new name. I mean, let's look at the differences between QE2 and what I think is QE3. Quantitative easing 2, the Federal Reserve bought $600 billion worth of long-term treasuries. Quantitative easing 3, Operation Twist, they bought $400 billion worth of long-term treasuries. Quantitative easing 2, and that was the intention was exactly the same, to bring down long-term interest rates to incentivize investors to buy automobiles, to buy cars, and other big-ticket items that normally you would need longer-term interest rates lower in order to buy them. Like the 30-year mortgage rate is now like, 409 was the last number I saw last week? That's why they've done this. The difference between QE2 and Operation Twist is QE2, in order to buy the long-term bonds, they printed cash. They printed money, $600 billion to buy all those long-term bonds. Well, there's always an unintended consequence. When they printed all the cash, that became dilutive to the dollar. The dollar started to go down because there was more dollars out there in the economy, more dollars to compete against for the same barrel of crude oil, the same ounce of gold, the same bale of hay, other commodities. Commodity prices went up. When commodity prices go up, it hurts the consumer. Gasoline goes up, gold goes up. Well, gold goes up as a result of the weak dollar. But food and fuel became very, very expensive as a result of the weak dollar, which was as a result of quantitative easing too. The difference is Operation Twist are not going to print any more money. I'm guessing that there's a bunch of people that got together and complained to the congressman and said, listen, Congress, please tell Mr. Bernanke that, we know he's got a tough job, but tell him not to print any more money. Because every time he prints money, my fuel bill goes up and my food bill goes up. By the way, the Federal Reserve is supposed to be completely independent of Washington, of Congress, of the political process. More so than lately, I think it's not, though, which is a little bit scary, sad, not so good. But at any rate, the Federal Reserve said, okay, we're going to buy $400 billion worth of long-term bonds. To finance those purchases, we're going to sell an equal amount of short-term bonds. They're going to buy bonds, anywhere, I think, from 6 to 30-year maturities, and sell bonds in their portfolio. They have a whole portfolio of treasury bonds. Sell bonds of 3 years or less. Now, to buy the long-term bonds, long-term bond prices go up, long-term yields go down. They sell the short-term bonds, the short-term bond prices go down, the short-term bond yields go up. Long-term yield goes down, short-term yield goes up. Long-term bonds, a 30-year bond, right now pays 2.71%. I have to this chart though. Here. USGG 10-year, that's the Bloomberg 10-year charts. And then we compare that to USGG 2-year. All right. I'll refresh the chart in case anybody can't see. Take a look at this. Oh, sorry. This is a 10-year bond. This isn't even the really long-term bond. This is a 10-year bond, but it's okay. 10-year bond right now pays 1.74%. It was paying 3.6% going back to March, April, May of this year. 3.6 to almost 1.6. That is 200 basis points. 200 basis points, 2 full percentage points, which I know doesn't sound like a lot of money, but in the bond market, it's huge. Here is the 2-year bond, which has also gone down. In fact, you know what? This is not a fair comparison. Let me do this. Operation Twist was announced when? The mid-September, right? Okay. So here's a 2-year bond. For mid-September, the 2-year bond paid 0.16 and now pays 0.25. That's 10 basis points up. Plus 10 BPS, and 100 basis points, by the way, is 1 full percentage point. And that's on the 2-year bonds. Okay? That's from mid-September until now. Okay. The 10-year, which I hope everyone can see, from mid-September until now, well, we did go up, but then we came back down. We were at lows of 171, but guess what? We're back down. We're at 174. And we were up at levels of 202. 202, and now I know it's not completely fair comparison, 174, but, sorry. Let me refresh the chart here. 174 goes down by 25 basis points. In other words, the Fed's intention. Did I send everyone the second link? No, I did not. Here it is. Oh, yeah. Is this the second link? That's the 10-year. And then I'll send everyone the other one. Just the 2-year. long-term and short-term bonds. By the way, if it's a 30 years, even more relevant, even more obvious, I should say. The Fed's intention is to lower long-term rates and increase short-term rates. That's one of the reasons why I think the dollar is so strong, and one of the reasons I think the dollar will continue to be strong. What's the dollar? The dollar is basically the shortest term bond. You have the 30-year bond that pays 2.71%. The 10-year bond is shorter maturity, smaller yield, 1.74%. 5-year bond, shorter maturity, shorter yield, 0.85%. 2-year bond, 0.24%. Federal Reserve interest rates, 0 to 0.25%. So, when the Fed's basically selling the short-term bonds, the bond price goes down, the yield goes up, it's forcing the dollar higher. Put that in conjunction with the fact that a lot of traders, including myself, are afraid to buy the yen and buy the Swissy because they're nervous about intervention. The dollar seems to make a lot more sense. But unintended consequences. Remember the unintended consequences of the weak dollar, which hurt those consumers because oil went up and food went up. What are the unintended consequences of Operation Twist? Well, a couple different things. Think of a bank, in which banks are certainly in trouble right now in the U.S. and in Europe and a lot of other places. Banks do not need any more problems right now. Banking represents a very large part of the U.S. economy as well. And the banks, on the most basic level, the business model is to pay interest, low interest, on savings accounts and lend to give loans at higher rates of interest. Well, the low yields, the interest rate that banks lend at, think of that as a 2-year bond. 2-year bond right now pays 0.24% yield. When the bank lends money, they lend money, let's say a 30-year mortgage. A 30-year mortgage is 4.09%. That's actually more than the 30-year bond, which is 2.72. But I think you get what I'm saying. That the bank's profit margin is the result of the difference between the long-term bond yield minus the short-term bond yield. Operation Twist, which is reducing long-term bond yields and increasing short-term bond yields, is cutting right into the profit margins of the banks. So actually, Washington has done quite a few things to hurt, that have resulted in hurting the banks. Whether that's their intention, I can't imagine it would be, but whether that's intention or its unintended consequences, it has not been good for banks. The big story now is Bank of America, that they've imposed a $5 fee per month, $60 a year, for all debit card transactions. That's not good. The customers are really unhappy, and they're probably going to lose a lot of customers. But Bank of America says we have to do that because it was actually the result of a change in the regulation, that debit card purchases were being charged at a higher rate in stores and shops. And because the government said, okay, we're capping that, Bank of America says all that money, right or wrong, all that money that Bank of America was earning, they're not going to earn anymore. The last thing Bank of America wants to do is anger their customers now in the precarious state that they're in. But, and I'm not necessarily defending them or against them, but it's ABC. I mean, there's a very clear connection between something that occurs in Washington and the results to Wall Street. So another unintended consequence of this Operation Twist, which I think a lot of analysts haven't really given enough credence to yet, is the fact that it's leading to a stronger dollar. A stronger dollar hurts exports. Our exports are produced by the manufacturing sector. The manufacturing sector happens to be what has been one of the strongest sectors in the economy. If the manufacturing sector starts to slow down, which it already kind of it has, if that has slowed down, or if that does slow down, then all of a sudden we have our banking sector, which is the weakest sector of the economy, gets weaker. Then manufacturing, which is the strongest sector of our economy, starts to get weaker. And by the way, I think that's also why crude oil is going down. Everything is connected. That's why I think foreign exchange traders, that it's important to I know there's a lot of information out there, but try your best to really appreciate every single angle of what one market can do to another. If we speculate that manufacturing is going to slow down, manufacturing consumes oil. If manufacturing will consume less crude oil, the price of crude oil will go down. The price of crude oil has gone down. Now, what are some symptoms that I think that stocks will go down? Well, there's an old trick for stock day traders. They say in a bull market, stocks tend to ignore bad news and focus on good news. In a bear market, stocks tend to ignore the good news and focus on the bad news. I drew this ISM. I wrote US ISM. That was yesterday's ISM manufacturing data. Better than expected. Prices paid, better than expected. Construction spending, better than expected. This is a 15-minute chart of the Dow. The Dow did go up as a result of these better than expected numbers. But very, very quickly, the Dow Jones Industrial Average said, hey, one economic number does not make a trend, which is, by the way, the title of the article that should be on FX Street now. One number does not make a trend. This long-term trend to the downside is a result of a lot more than just one little silly manufacturing number. Yes, that's great. Manufacturing is going up more than expected, but we have bigger issues on our plate. Okay. In terms of earnings season, what can move the markets? Stocks can move the markets. Take a look at this page. I'll send everyone the link. These are the 30 most influential stocks in the United States, which represent the Dow Jones Industrial Average. Of course, there are other stocks out there in the S&P 500, and I guess I wouldn't say the most influential because, you know, you do have Apple, and that's probably has the biggest market cap. ExxonMobil, I think ExxonMobil can flip. Let me get to some of these questions, by the way. Jack says, too low yield of long-term bond. Will these bond lack attract for buyers? Well, the yield goes down. You are right. If I understand your question correctly, if the yield goes down, less buyers will buy the bonds because they say, hey, you know, why am I buying the 30-year bond? It only pays 2.73%. But then again, when the yield goes down, the bond prices go up. So in other words, a trader who already bought the 30-year bond, they're actually making money because when the yield goes down, the prices go up. Same thing in a stock. You know, AT&T right now pays a 6% dividend because the stock is so cheap in comparison to its dividends. But when the stock price goes up, the dividend as a percentage of the price actually goes down. But if you buy the stock, you're actually making money. So in a sense, when bond yields go down, the people who are already in the bonds are making money. And maybe the people who want to buy bonds, to speculate on bonds, they might buy them also. Is it true that American technology is getting outdated as a result of losing competitiveness? I don't think I'll go to jump to that extreme. I mean, there was a story yesterday how the iPhone, they will not be able to sell the iPhone in India because the broadband connections, I don't even know if it's broadband, but the internet connections there are not strong enough to support the iPhone applications. But no, I think that, you know, you look at U.S. competitiveness in terms of technology, I don't think that's a threat. I think the threat is the fiscal policy in the U.S., the out of control spending in Washington, and some of the poor choices. And I think the biggest threat we have is the political system. We're getting into, you know, a period of time, an election cycle every 4 years. This is going to be a really ugly election cycle. Now, remember how the stocks really didn't move in July because everybody was waiting for that debt ceiling, the solution to the debt ceiling? Well, they agreed to raise the debt ceiling. They didn't agree where to get the spending cuts from. They formed a super committee. A bunch of Democrats and a bunch of Republicans got together, or are getting together, and they're going to try to find a way to find the money to cut spending, raise taxes, or do something to raise the debt ceiling, which to pay for the increase in the debt ceiling, which occurred last August. That super committee, I think, is meeting now and has not made a decision. and has a deadline of Thanksgiving. Picture a market, October earnings season, banks are reporting not so good numbers. Manufacturers are reporting not so good numbers because of Operation Twist. And all the while, the super committee gets in front of the TV every day and says, we have 3 days until Thanksgiving. We have to make a decision. You know, the other guys aren't playing nice with us. And by the way, we have an election cycle, so I have to be really careful what I'm going to say. I think what happened in August with the stock market going down because Standard & Poor's downgraded us, I think we could see a repeat version of that. I think S&P is watching us very, very closely to see if our political system is any better. I don't think it is. By the way, and that's my opinion. By the way, in terms of earnings season, what stocks to watch? Well, the most influential stocks are in the Dow Jones Industrial Average. Alcoa is on the 11th, 14th, I can't remember. Alcoa will be the first. Alcoa, by the way, is a steel producer. Aussie is a steel or metals-based currency. The Aussie dollar has gone down a lot lately. Alcoa stock has gone down a lot lately. Look to a correlation between the Aussie and Alcoa. Will Alcoa miss earnings? Well, a lot of their earnings have been earned as gold and other commodity prices. Copper has gone down a lot. Look at some of the other Dow components, like American Express, Bank of America. What's the other one? JP Morgan. Yeah, 3 banks in the Dow Jones Industrial Average. We have stocks in the Bank of America. We have a lot to talk about that. Stocks that are exporters, like Caterpillar. Well, Caterpillar exports a lot of their tractors. They did very well with a weak dollar environment. All of a sudden, now the dollar is a little bit stronger. Those Caterpillar tractors are a little bit more expensive. Chevron, ExxonMobil, 2 of the biggest oil companies in the world, oil is down. They're not going to earn as much. We can look at, Kraft Foods. They benefit from high commodity prices because they sell food. That's down. Commodity prices are down. Coca-Cola as well. Then we look at, let me see here. Walmart has a big issue in terms of the exchange rate between the dollar and the yuan. And there's been a little bit of a political back and forth, at least with the past 24 hours, between the U.S. and China about that exchange rate and the policies. Basically, the U.S. is telling China, hey, you need to readjust. You have to allow the yuan to trade more freely. It's not fair. And China is basically telling the U.S., hey, we can do what we want to do. Mind your own business. So that cannot be good for Walmart. Can I say a word or two about the Chinese influence in my commodities and currency market? Well, I only have about 30 seconds left, but I will tell you to read the statement. Go on Google and look for Reserve Bank of Australia. I'll go on right now. Reserve Bank of Australia. Reserve Bank of Australia. They just announced their interest rate decision last night. Where is it? October 4th. Here's the link. The RBA, which is a very big supplier of commodities to China. China is a manufacturer. Australia is a commodity producer. Where did they talk? So if you want to know about China, look to Australia because China's buying a lot of the commodities from Australia. It says it will take more time for evidence of any effects of the recent European-U.S. financial turbulence and economic activity in the regions to emerge. Australia says thus far indications are that economic activity is continuing to expand in China and most of Asia. Nonetheless, recent events have led forecasts to reduce estimates. Last night, I believe Goldman Sachs downgraded almost all of Asia. Their forecast for almost all of Asia, excluding Japan. I think Japan was the only. By the way, I think there's a holiday in China, right? So markets in China haven't really reacted to what's happened over the past 24 hours. I think there's a week-long holiday, if I'm not mistaken. But in other words, I think that if manufacturing slows down in China, that will have an adverse effect to Aussie. very much faster than it would to the U.S. It'll scare us, but Australia sells their commodities to China. So there has been some indication that the numbers are starting to slow down. It's like watching Apple computer stock, that it's been so strong for so long, it's best not to bet against it. But if it starts to slow down, it could mean really, really big things. By the way, the last thing I was going to say is, in terms of the earnings season, look to those 30 stocks in the Dow Jones Industrial Average. Those prove to be the most volatile, or most influential, I should say, companies to report their earnings, including Alcoa, American Express, Boeing. I don't have to, listen to the link. I don't want to bore you reading the list. But there are issues. Look at Hewlett-Packard, with a board of directors that really can't get out of their own way. I believe Goldman Sachs, is it Goldman Sachs? I believe Goldman, you have to look around for the news. I believe Goldman Sachs downgraded their estimates as far as the output in Asia. Basically the financial, I don't know if it was GDP that they were looking at specifically, but they downgraded their estimates in all of Asia, excluding Japan, I believe. Includes Korea, the Philippines, and the other, smaller economies, but certainly very influential. Look to these stocks for guidance, and like I said, there's definite correlations even between currencies. Alcoa is a steel producing company. We can make a safe assumption that's going to move very closely or pretty closely with the Aussie currency. You look to the banks, well, there's a lot of fear about the banks in the U.S., but also in Europe. So if we have bad numbers in Bank of America, I cannot imagine how there would be good numbers. If there's bad numbers in Bank of America, if there's bad numbers in JP Morgan or the other big banks, that would be not so good for the U.S. It might not also be good for Europe, because this debt contagion crisis, this is like a virus. It's being transmitted through the banks. So what's bad for U.S. banks is bad for European banks, and what's bad for European banks is bad for U.S. banks. And there's certainly a lot of, we can look at McDonald's. If McDonald's numbers are bad, I have a suspicion they will be, because I think an analyst had recently downgraded over the past couple months, projecting that they're going to sell less hamburgers. But if McDonald's comes back and says, yeah, our numbers are bad because we're not selling any hamburgers in Europe, maybe that translates over to the euro currency. I don't think the euro currency will react to McDonald's, but it might give us another hint as far as the future of the currency, the future of the economy. The trend is your friend. Honor the trend in October, because the trend is fueled by major macroeconomic fundamentals. I know the markets have been range-bound over the past couple months, and it has been appropriate to buy low, sell high. But when you look at the daily charts and look for those breakdowns, if and when the charts eventually break down or break out, it's best to honor those trends. And in October, hopefully can prove to be a very profitable month if we pick those trends correctly. I'm out of time. If you want to contact me, please feel free to do so, www.forwardslash.com. Please see FX Street's calendar, because we have a lot going on this month in October. This is going to be a really good month. Again, I want to thank you all very much for joining us. Wish you a great day. All profitable trades. And we look forward to seeing you back soon. Back in the